Every second, the U.S. national debt grows by $45,000. If you watch the debt clock, it looks like a ticking time bomb. The retail investor looks at this number, 36 trillion, 40 trillion, and asks one question: when will the U.S. government default? They are terrified of a crash. They are waiting for the moment the checks bounce and the ATMs stop working. But I am here to tell you, the U.S. government will never default, not in the way you think. They will not stop paying the bonds. They will not shut down the Treasury. Why would they? They own the printing press. A man with a printing press never goes bankrupt in his own currency. But this is where the trap lies. The smart money isn't afraid of a formal default. They are afraid of the solution. To save the sovereign, they must sacrifice the currency. We are not heading for a crash. We are heading for a silent default. A slow, calculated liquidation of your purchasing power, disguised as targeted inflation. The dollar in your pocket isn't dying, it is being murdered. To understand why this is inevitable, we have to look at the budget. For decades, the U.S. government could ignore the debt because interest rates were near zero. It's easy to owe $30 trillion when the interest payment is free. But that era is over. In 2024, a terrifying line was crossed. The U.S. government now spends more on interest payments on the debt than it spends on the entire national defense budget. Think about that. We are spending more to pay bondholders than we are to pay the Army, Navy, Air Force, and Marines combined. This is what we call a debt spiral. To pay the interest, the government must borrow more money, which increases the debt, which increases the interest. It is a mathematical loop of death. There are only three ways out of a debt spiral. 1. Austerity. Cut spending. This is politically impossible. No politician will cut Social Security or Medicare and survive the next election. 2. Growth. Grow GDP faster than debt. This is demographically impossible. Our workforce is shrinking and productivity is stalling. 3. Inflation. Print the difference. The smart money knows that option 3 is the only path left. They aren't guessing. They are positioning for the flood. History doesn't repeat, but it rhymes. We've been here before. In 1945, after World War II, the U.S. debt-to-GDP ratio hit 120%, similar to where we are today. How did they fix it? Did they tax everyone to death? No. Did they default? No. They used financial repression. The Federal Reserve capped interest rates at 2.5%, but they let inflation run hot at 6, 7%, even 10%. Do the math. If you are a saver holding a bond paying 2.5%, but inflation is 7%, you are losing 4.5% of your wealth every single year. For a decade, the government essentially stole purchasing power from bondholders to pay down its war debt. It worked. By 1955, the debt-to-GDP ratio had collapsed, not because they paid it off, but because they inflated it away. This is the silent default. The numbers on the bond stayed the same, but the value of the money inside it evaporated. The smart money sees the Fed setting up the exact same board game today. They are preparing to sacrifice the saver to save the system. So how do they execute this theft without causing a revolution? They use mechanisms hidden deep in the plumbing of the financial system. The first is yield curve control. In a free market, if inflation goes up, bond investors demand higher interest rates to compensate them. If inflation is 5%, I demand 7% yield. That is fair, but the government cannot afford to pay 7%. It would bankrupt them. So the Federal Reserve steps in. They become the buyer of last resort. They print money to buy the bonds, artificially forcing the interest rate down. But there is a second, darker mechanism, the reverse repo facility. Think of this as a mattress for the banks. When the banks have too much cash, the Fed pays them to park it overnight. This allows the Fed to drain liquidity from the system when they want to hide inflation and pump it back in when they need to bail out the government. It is a shell game. They move the money from the left pocket to the right pocket to confuse the public. But the result is always the same. The currency gets debased, and the assets get inflated. This brings us to the moral crime of the silent default, the Cantillon effect. Richard Cantillon was an 18th century economist who realized a simple truth. Money is not neutral. When the government prints new money, it doesn't fall from the sky evenly on everyone. It enters the system at specific points, usually Wall Street banks and government contractors. These first receivers get to spend the new money before prices rise. They buy the Hamptons houses, the stocks, the art. By the time the money trickles down to the wage earner, the last receiver, prices have already doubled. The waitress, the teacher, the factory worker, they are paying for the bailout of the bankers. Inflation is a regressive tax that hits the poor the hardest. The smart money understands this hierarchy. They position themselves close to the spigot of money creation. They own the assets that inflate. They borrow the money that depreciates. In a silent default, debt is an asset for the rich and a liability for the poor. But there is a new threat in 2025 that didn't exist in 1945. In 1945, the U.S. was the only game in town. The world had to buy our debt. Today, the world is walking away. We are seeing the acceleration of de-dollarization. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively building a payment system to bypass the dollar. Why? Because they see the debt spiral too. They know the math doesn't work. Look at the central banks. In 2024 and 2025, central banks bought gold at the fastest pace in 50 years. China is dumping U.S. treasuries and buying gold. They are trading paper promises for physical truth. When the biggest buyers of your debt decide to stop buying, you have a crisis. This forces the Fed to print even more to make up the difference. The exit door is getting crowded, and the smart money is trying to squeeze through before it slams shut. For 40 years, financial advisors gave you one piece of advice: the 60-40 portfolio. Put 60% in stocks for growth and 40% in bonds for safety. The theory was that when stocks crash, bonds go up. They were the hedge. That theory is dead. In a silent default, stocks and bonds fall together. In 2022, we saw the worst year for the 60-40 portfolio in a century. Both asset classes collapsed. Why? Because inflation hurts both. If you are holding 40% of your retirement in government bonds, you are holding 40% of your retirement in a burning building. The smart money has abandoned the 60-40. They have moved to the endowment model. They hold real assets, private equity, and commodities. They know that safe government bonds are now return-free risk. If your advisor is still putting you in long-term treasuries, they are driving you off a cliff using a map from 1980. So if the game is rigged against the saver and the traditional portfolio is broken, what is the winning move? You must exit the system. You must trade the melting ice cube, fiat currency, for the unsinkable boat, hard assets. The smart money is currently executing a massive rotation. Central banks are buying gold. Why? Because gold is the only currency they can't print. It is the hedge against their own incompetence. Tech visionaries are buying Bitcoin. Why? Because it is the only asset with a mathematically capped supply. It is an escape hatch from the fiat system. Billionaires are buying farmland and commercial real estate. Why? Because land is finite. The common denominator is scarcity. In a world of infinite paper, the only safe harbor is the finite. If you hold your wealth in dollars, you are betting that the politicians will suddenly become responsible. If you hold your wealth in hard assets, you are betting that they will continue to be irresponsible. Which bet do you think is safer? Let's summarize the investigation. The national debt is unpayable. A formal default is impossible. Therefore, a silent default, inflation, is guaranteed. The smart money playbook is simple, but requires courage. 1. Get out of the yield trap. Do not hold long-term government bonds. They are certificates of confiscation. 2. Minimize cash. Keep only what you need for emergencies. The rest is melting. 3. Own hard assets. Allocate to gold, Bitcoin, commodities, or real estate, anything that cannot be printed. 4. Good debt. If you can borrow cheap fixed-rate debt to buy a cash-flowing asset, do it. Let inflation pay off your loan for you. The rules have changed. The saver is the loser. The owner is the winner. Do not let your labor be stolen by a printing press. This is the smart money wisdoms. The future belongs to the owners.